Welcome to the deep dive. Today, we're really getting into something fundamental for anyone in business or finance.
hmm
Understanding how businesses are valued.
That's right. We've got some great source material covering the core ideas.
And our mission really is to unpack all that, pull out the essentials, and basically give you a shortcut to getting up to speed on this. It's pretty crucial stuff.
Absolutely. And we should probably start with the most basic idea, shouldn't we? That value creation. It happens when your return on capital is greater than your cost of capital.
Simple idea, big implications. Because valuation isn't just for, huge takeover deals, right?
Oh, definitely not. It touches almost everything. Think about raising money early on, deciding where to invest, figuring out prices for buyouts, mergers, financing decisions. Even paying dividends involves some thought about value.
Yeah, it's everywhere. Issuing shares, restructuring,
Resolving shareholder disputes.
buying or selling part of a business. Even, unfortunately, things like insolvency.
And valuing those intangible things like brand names. It all comes back at this concept of value. And like Alfred Marshall pointed out, generating that value sustainably is key for any organization's health.
Okay, so let's nail down what we actually mean by business valuation. It's not like weighing something on a scale, is it?
No, not at all. Fundamentally, business valuation is an estimate, or maybe an opinion of a business's value, usually fair market value.
An estimate.
And crucially, at a specific point in time. It's not a hard number from a simple formula. It takes, understanding a lot of factors, professional judgment, real experience.
Okay, so right away, that tells us a few things. Like, it's an estimation. Does that mean different people could value the same business differently?
Exactly. You won't necessarily get one single correct number, like in physics. And another really key point, value isn't the same as price.
Ah, right, the Warren Buffett quote.
That's the one. Price is what you pay, value is what you get. Price can be influenced by all sorts of things in a specific deal, who the buyer is, how desperate they are, special synergies only they see.
The value is the underlying worth we're trying to estimate.
So valuation tries to figure out the get, price is the pay. Makes sense.
And value changes constantly. It's time-specific. A valuation today could be out of date tomorrow if big news hits.
Right.
And of course, every single business is unique. Its industry, its history, its market niche. Context is everything.
Okay, so it's an informed guess, basically. Context-dependent, time-sensitive. How do you even start framing that guess? Does it matter why you're doing the valuation?
Oh, profoundly. That's the valuation premise. It's the assumption about what's going to happen with the business after the valuation date. That premise really shapes the whole approach.
You mean are we assuming it keeps running or is it being shut down and sold off?
Those are the main ones. The most common, especially for healthy companies, is the going concern premise.
Okay.
You assume the business keeps operating indefinitely, using its workforce, its assets, its customer base, everything. This is typical when a lot of the value is tied up in how it operates as a whole, its intangibles. And the opposite, if it's not keeping going.
That's the liquidation value premise.
Right.
Here, you value it based on selling off the assets individually, piece by piece.
Right.
And you have to subtract the costs of doing that sale. There are flavors too. Orderly liquidation means you have a reasonable amount of time to sell.
Okay.
Whereas forced sale is urgent, like a fire sale. You usually get less money then.
Going concern for running, liquidation for selling off. Is there anything else?
Yeah.
Like finding the best possible use.
Yes, that's the highest and best use, or HABU premise. This asks, what's the use of an asset, or even the whole business's assets, that's legally allowed, physically possible, financially workable, and results in the highest value?
Interesting.
It's often used in real estate, but think about a company's patent. Maybe its highest value isn't in their current products, but licensed out somewhere else. It forces you to think beyond just how things are now.
That's a really useful framework. Okay, so the premise sets the stage. Now, the actual techniques, the tools valuers use. The sources mention three main approaches.
That's right. The three big ones: market, income, and cost. Each comes at value from a different direction.
Let's start with the market approach. Sounds like looking at comparable sales.
Exactly that. It's based on substitution. What would it cost to buy a similar thing? You estimate value by looking at recent sale prices or current trading prices of comparable assets, or more often, comparable companies.
So you look at PE ratios of similar public companies.
Yep, that's one method. The comparable companies multiple method, using things like PE or maybe EBITDA. Or you might look at the prices paid in actual M&A deals for similar private companies, the comparable transactions method.
Okay. Seems straightforward enough.
Oh.
But What's the catch? Finding companies that are truly comparable must be the hard part.
That is the major challenge. No two companies are identical. You have to adjust for size, growth, risk, profitability, debt levels, so many things.
Right.
It works best when you've got lots of good, recent, transparent data on very similar businesses. For some unique private company, much tougher.
Okay. So, market data driven, but comparability is tricky. What about the income approach? This sounds more forward-looking.
It is. The income approach is all about the future. What economic benefits, usually cash flows, do you expect this business to generate? Then you convert those future amounts back into a single value today.
Using a discount rate.
Exactly. The logic is a business's value now is the present value of all the cash it's expected to produce over its lifetime.
And this is where discounted cash flow, or DCF, comes in?
DCF is a cornerstone method here, yes.
Mhm.
You project future cash flows year by year, maybe for 5 or 10 years, then estimate a terminal value, and then you discount all of that back to today using a discount rate that reflects the riskiness of those cash flows.
What other income methods are common?
Well, if a business is very stable, you might use capitalization of earnings, basically taking a representative year's earnings and applying a capitalization rate. Or for some companies, the dividend discount model, focusing just on expected dividends. But DCF is probably the most versatile.
And the challenge here, guessing the future,
Yeah.
seems, well, uncertain.
That's its Achilles heel. The valuation is highly sensitive to your assumptions. Future growth rates, margins, capital needs, and especially that discount rate. Small tweaks can cause big swings in the final number.
Right. Requires a lot of judgment calls on those inputs.
It really does. Robust forecasting, solid justification for your assumptions. That's key.
Okay. Market looks back at comparables. Income looks forward to earnings. What's the third one? The cost approach.
The cost approach also uses the principle of substitution, but it asks, what would it cost to replace or reproduce this asset or this collection of assets today?
So, like, how much to build this factory again from scratch?
Pretty much. You'd estimate the cost to build it new, then subtract for depreciation, wear and tear, obsolescence. Methods include replacement cost, reproduction cost, or sometimes just looking at the net asset value, NAV, on the balance sheet.
When would you use this? Doesn't seem ideal for, say, a software company where the value is mostly ideas.
You're spot on. It's much less useful for businesses heavy on intangibles or where the value comes from the ongoing operation, the going concern value. It's more common for asset-heavy businesses, holding companies, maybe valuing specific tangible assets within a company, or sometimes as a sort of sanity check, especially if income or market data is really thin.
So it tells you the cost of the ingredients, but not necessarily the value of the cake.
That's a pretty good analogy, actually, yes.
And in practice, valuers might use more than one approach, kind of triangulate.
Oh, yeah, very often, yes. A good valuation will typically consider multiple approaches if possible. The specific situation, the type of business, why you're doing the valuation, what data is available, dictates which approach gets the most weight.
Okay. Now, something that seems to run through all of this, especially the income approach with its discount rate and even market multiples reflecting expectations, is risk and return. The source has hammered this home.
It's the absolute bedrock concept. Investors demand a higher return for taking on more risk. It's fundamental. Value is directly tied to the future returns you expect, adjusted for how risky those returns are.
So let's define return simply first.
Return is just the total gain or loss on an investment over a period. For a stock, it's dividends plus the price change. In valuation, we're usually focused on expected returns, the future profits or cash flows we anticipate.
Okay. And risk.
Risk is the uncertainty around that expected return. The chance that what actually happens is different from what you predicted. Often we focus on the downside, risk the chance of loss or underperformance. Statistically, standard deviation measures volatility, but finance breaks risk down more specifically.
Right, into systematic and unsystematic risk.
Correct. Systematic risk is the big picture risk, market risk. It affects pretty much all investments because it's tied to broad economic factors, interest rates, inflation, recessions, geopolitical shocks. You can't diversify this away just by owning lots of different things.
It's unavoidable market exposure.
Essentially, yes. Then you have unsystematic risk. This is the company-specific stuff. Risk unique to one firm or maybe one industry.
Like what?
Oh, a key product fails, a top executive leaves unexpectedly, a factory burns down, a damaging lawsuit, things that hit one company hard but maybe don't affect the whole market.
And the crucial difference is You can do something about unsystematic risk.
Exactly. Through diversification. If you hold a portfolio of different assets whose specific risks aren't perfectly correlated,
Don't put all your eggs in one basket.
that's the classic saying, the company-specific ups and downs tend to cancel each other out across the portfolio. Modern portfolio theory showed that diversification reduces your total risk by essentially eliminating that unsystematic firm-specific chunk without necessarily lowering your expected return.
So if you're a well-diversified investor, you're mainly worried about the systematic risk, the market risk you're still exposed to.
That's the theory. And that's where beta comes in. Beta measures a stock's sensitivity to that systematic market risk.
How much it moves with the market.
Precisely. A beta of 1 means it tends to move in line with the overall market. Beta greater than 1, it's generally more volatile, more sensitive to market swings. Less than 1, less volatile.
And that feeds into things like the capital asset pricing model, CAPM.
It's a key input for CAPM, which tries to estimate the expected return needed to compensate for that systematic risk.
But the sources also pointed out that beta isn't the whole story, especially for private companies.
That's a really important practical point. Beta captures market sensitivity, sure, but in real-world valuations, especially for private businesses, there are other risks beta doesn't fully capture.
Like,
Well, think about a small private company. It might be overly reliant on 1 or 2 big customers, or depend heavily on the owner-manager. Maybe it's geographically concentrated. These are real risks a buyer is taking on.
risks that a diversified public market investor might ignore, but someone buying the whole company can't.
Exactly. So valuers often add specific risk premiums on top of what CAPM might suggest to account for these factors: size risk, customer concentration risk, key person risk, things that increase the uncertainty for a potential buyer of the whole business.
That makes sense. Risk isn't just one neat number. Okay, let's shift slightly. To actually use the income or market approaches, you need to understand the company's health and performance, right? Financial statement analysis.
Absolutely vital. Financial ratios derived from the income statement, balance sheet, cash flow statement. They're like the diagnostic tools that help you understand profitability, efficiency, liquidity, solvency, the company's financial pulse.
You pore over these to see historical trends, current health, potential red flags.
Exactly. Valuers and investors spend a lot of time on this.
Can you give us a quick tour of the main categories
Yeah.
without drowning us in formulas?
Sure. You've got profitability ratios like return on equity, ROE, or net profit margin. They tell you how well the company turns sales or investment into actual profit.
Okay, how profitable?
Then, liquidity ratios. Current ratio, quick ratio. These look at short-term health. Can the company pay its upcoming bills? Does it have enough ready cash or near cash assets?
It's important for staying afloat day to day. What about longer-term stability dealing with debt?
That falls under solvency or debt ratios. The debt-to-equity ratio is a big one, how much borrowed money versus owner's capital. Higher debt means higher risk because interest has to be paid no matter what.
Right.
Then you have things like interest coverage ratio or debt service coverage ratio, DSCR. These show if the company's earnings are enough to comfortably cover its interest payments or even interest and principal repayments. Lenders watch DSCR very closely.
I bet. They want to see a good cushion.
Definitely. Though what counts as good varies a lot by industry. 5x or 6x might be great in one sector, maybe less critical in another. Context matters.
Always context. Okay, what else? Efficiency.
Right. Efficiency or activity ratios. How well does the company manage its assets? Inventory turnover shows how quickly it sells its stock. Debtors turnover, or accounts receivable turnover, shows how quickly it collects cash from customers. Faster is generally better.
Speaks to how well the operations are running.
Yes. And finally, you have market ratios, mainly for public companies. Price to earnings, PE, price to book value. These compare the stock price to earnings or net asset value. High PE might mean high growth expectations, or maybe it's just expensive. You always compare these to peers.
Makes sense. The sources also mentioned capital structure analysis and credit analysis here. How do they fit in?
They're closely related. Capital structure is just looking at that mix of debt and equity financing. Analyzing it means looking at those debt ratios again to understand the risk from leverage. Credit analysis is often a deeper dive, maybe by a bank or bond investor, focusing specifically on the company's ability and willingness to repay its debts. It looks at everything: financials, cash flow, management, industry position, to assess default risk. This directly impacts the interest rate the company pays on its debt, which feeds back into valuation, especially the discount rate.
Got it. So financials give us history and health. But There was a lot of emphasis on cash flow, too. Cash is king.
Absolutely. Accounting profit, net income is important, but it can include non-cash items like depreciation or be affected by accounting choices. Cash flow is often seen as a clearer picture of the actual cash coming in and going out. Can the company really pay its bills, invest, return money to owners?
And the cash flow statement tracks that.
Exactly. Shows cash from operations, investing, financing, really useful.
And then we get into free cash flow, FCF.
Right. Free cash flow, FCF, is a key concept. It's basically the cash generated by the business after paying for operating expenses and after making the necessary investments in things like equipment or buildings, the capital expenditures needed to maintain or grow the business.
So it's the leftover cash, the surplus.
Pretty much. It's the cash potentially available to be distributed to the company's capital providers, its lenders and owners, without harming the business's operations.
And there were two types mentioned, FCFF and FCFE.
Yes, important distinction. FCFF is free cash flow to the firm. That's the cash flow available to all investors, both debt and equity holders. It's calculated before interest payments to debt holders, but after taxes and reinvestment. You use FCFF when you're valuing the entire company's operations, the whole enterprise.
Okay, cash for everyone involved.
Right. Then FCFE is free cash flow to equity. This is the cash flow available only to the common shareholders after all expenses, debt payments, interest and principal, and after accounting for any new debt issued or repaid.
So you'd use FCFE if you were just valuing the stock?
Exactly. If you're valuing just the equity piece, FCFE is the relevant cash flow stream to discount. Using the right one, FCFF or FCFE, depends on whether you're aiming for the value of the whole firm or just the equity portion.
That clarifies that. Okay, one final distinction that often comes up, market value versus enterprise value. How should we think about these?
Yeah, they definitely get confused sometimes. Market value, especially when people talk about public companies, usually means the equity market capitalization.
Share price times number of shares.
Exactly. It's the market's current price tag on the ownership stake, the equity. In a broader sense, fair market value is that theoretical price between a willing buyer and seller. But in practice, especially for comparisons using market multiples, market value often just means market cap.
Okay, so market value, equity value usually. What about enterprise value, EV then?
Enterprise value tries to capture the value of the entire company, its core operating business. Think of it as the theoretical takeover price. If you bought the whole company, you wouldn't just buy the stock, you'd also have to take responsibility for its debt.
Right, you inherit the debt.
So the common formula is EV equals market cap, plus the market value of the company's debt, minus its cash and cash equivalent.
Why subtract the cash?
Because if you buy the company, you get its cash hoard along with everything else. That cash effectively reduces the net price you paid for the operating assets.
Okay, so EV is market cap plus debt cash. It represents the value of the actual operations, regardless of how it's financed.
That's the idea. It strips out the effect of the capital structure to a degree. That's why valuation multiples based on EV, like EV to EBITDA or EV to sales, are often preferred for comparing companies with different debt levels. They're seen as giving a cleaner comparison of the underlying business's value-generating power than, say, a PE ratio, which is purely based on equity value.
That really helps distinguish them. EV for the whole operation, market value for the ownership slice.
It's a crucial distinction for understanding what different valuation metrics are actually telling you.
Okay, wow. We've covered a lot of ground here. We started with that core idea of value creation and why valuation is so pervasive. We stressed it's an estimate, not a precise science, and value is different from price. We looked at how the premise going concern, liquidation, highest and best use sets the stage. Then the three main approaches: market, income, cost, with their pros and cons.
Right. The tools of the trade.
Then the critical link between risk and return, systematic versus unsystematic risk, beta, and the importance of diversification.
And the practical point about adding specific risk premium.
Absolutely. We touched on analyzing financials, capital structure, credit worthiness, the importance of digging into the numbers.
And the focus on cash flow, FCFF, and FCFE.
And finally, clarifying market value versus enterprise value.
It really is a foundational toolkit for finance. And the key thing to remember through all of this is that while we have frameworks, formulas, data, valuation still involves a significant amount of professional judgment. Choosing the right approach, making reasonable assumptions, interpreting the results. It's part art, part science.
Definitely not just plugging numbers into a spreadsheet. And understanding these fundamentals, even at this level, is so valuable whether you're, looking at investments, prepping for negotiations, sizing up competitors, or honestly, just wanting to understand business news better.
Couldn't agree more. Which perhaps leaves us with a final thought for you, the listener, to chew on. Given that valuation is an estimation built on assumptions about an uncertain future and filtered through the perspective of the valuer and the purpose of the valuation, just how much can the perceived value of a single business genuinely fluctuate? Not just because the business changes, but simply based on who is doing the valuing and why. Something to think about next time you see a company valuation figure.